Welcome to module on taxation of trust. This is an important area because quite candidly, your clients will come to you or to the tax preparer saying, I've been either taxed too much in my trust or they didn't take enough tax out. We're going to explain why that occurs. So just bear with us as we go through the material. We have really 4 objectives here. Describe the 2 types of grantor trust. Explain the tax ramifications of an irrevocable trust. Understand the income sources for a trust, and then describe the taxation of the trust itself. Grantor trust is any of the following are present: where we have a reversion of the trust property to grantor at any time, where there's a revocable trust, where trust income can be distributed to grantor or held for future distribution to the grantor, the power of the grantor to control beneficial enjoyment of the trust, reservation of important administrative powers to the grantor. So it's an area that's very inclusive. IRS is always looking for this because they make the assumption the grantor is in a higher tax bracket than anybody else. So their goal is to find a grantor trust because in that case the grantor pays the income, although the benefits go to the trust and the beneficiaries. Taxation, first of all, we use a special tax form. It's Form 1041, which is the same tax return that's used for people who are dead under what's called the income receipt of the decedent. Its fiscal year is the calendar year, and the tax is due on the 15th day of the 4th month, which is April 15th. And I think you're probably going to see a problem, right? The tax is due on the trust the same day your tax is due, which means you're going to get the inputs from the trust after the April 15th, which means you have to have an extension if you have a trust. Trusts have their own tax rates, very high rates. They're at the 35, 39% rates with about $10,000 income. Therefore, you don't want to have income taxed by the trust. And finally, trusts are a separate taxable entity created by the grantor to hold property. That would be true of the irrevocable trust. Obviously, we're talking about it here. On revocable, that would not be an issue on any of those. Source of income, there's only 4 sources of income for a trust: dividends, interest, royalties, and rents. Very straightforward. Anytime you see someone having W-2 income in it, you know that they're going to get audited and disallowed. We have 2 types of trusts. Simple trust, meaning basically everyone who receives income as income beneficiaries pays tax, and they get all the income each year. If any of the income is held up back or goes to something that doesn't pay income tax, then it is called a complex trust, which means the logical conclusion is a simple trust and its last year being trust is a complex trust because the corpus is paid to the grantees, or another name of grantees is the beneficiaries. Income tax form required for all trusts over $600 of gross income. In other words, $600 gross income of any sort puts you into having to file a tax return. $1 of net income will have you file a tax return. Bankruptcy of the trust, or if there are any foreign beneficiaries, such as your aunt in Quebec, or your cousin was a beneficiary in New Brunswick. If income is not distributed to beneficiary, it is taxed to the trust. I might know there's a clarification there. It could also be taxed to the grantor if it was a grantor trust, which we described earlier. If distributed beneficiary is treated as having the same characteristics it did as in the trust. And beneficiaries are notified of the income they're receiving and the type of a taxable or non-taxable by the K-1 form. And they'll be taxed differently if it's interest versus rents. Distributable net income is limited to the amount of deduction for beneficiaries for the preceding year, or another way of putting it, DNI is what's going to be taxed to you. Anything above that amount is not taxed to you. And it's defined as providing the amount and character of the income reported to the beneficiary. So you're going to have your interest and dividends paid separately, long-term or short-term. You'll have your rents and royalties paid differently, etc. DNA is the trust distributable income less the amounts distributed to beneficiaries. We don't recognize personal exemptions, the $300 for simple trust and $100 for complex trust. Capital gains, if they are allocated to the corpus are not included. Dividends, if allocated to the corpus of simple trust, are not included. And fact, tax-exempt income reduced by related expenses is included. So that's the big exception. And we have two notes here. The trust income distributed deduction is lesser of NDI, or amount actually distributed to beneficiaries. In other words, income required to be distributed plus any amounts of taxable income distributed. And finally, distribution in excess of DNI are non-taxable. Trustee is required to file a K-1 for each beneficiary who receives income distributed during the estate's taxable year, and the tax credit to a trust are allocated between the trust and the beneficiaries based on the amount of income distributed. And sometimes there's some big tax credits, and you'll get part of it, and the trust gets part of it, or your beneficiaries get a part of it. Property distribution, no gain or loss is recognized, and beneficiary receives a carryover basis for any property. Trustee can elect to treat properties that were sold to distribute for the property's fair market value. And if appreciated gain is recognized and the distributees receive the fair market value for the property. If property is declined in value, a loss cannot be recognized. So the carryover basis gets losses, but not if for decline in value. And decline in value, for example, is if you have a depreciable asset. It declines in value from an adjusted standpoint, but it's not a true loss. Taxation on termination of a trust. Trust is not entitled to personal exemption on its final tax year. Prior to that, they have the $100 for complex trust and $300 for simple. Any unused tax carryovers from a trust are passed through to the beneficiaries for use on their individual tax returns. Again, that's on the K-9. Trust excess deductions for its final tax year are passed through to beneficiaries and can be deducted as miscellaneous deductions with a 2% limitation. In other words, you have to exceed the 2% miscellaneous to take advantage of the excess deductions. Special rules for taxation of trusts. Generally, multiple trusts can be treated as a single trust for tax purposes if the trusts have the same grantor and similar beneficiaries. And a simple way of putting it is I set up trusts for my 3 children. They're all basically the same kind of trust. They all have the same ground rules. For example, they get the money when they're 35. Well, I can treat them as one entity for tax purposes as long as, first of all, there's no independent purpose for each trust. Second, no avoidance of the progressive tax rate, or AMT. And finally, income from a grantor trust is taxable to the grantor and not to the trust or beneficiaries. So, and that grantor trust many times comes up when we talk about multiple trusts with the same goal. So you have to be very careful there. And I really suggest that if you're a trustee or you're working with a trustee, to make sure they use a CPA or someone who knows the tax rules. Trust is subject to the same expense rules as individuals, including but not limited to medical contribution tax on net investment income, audit minimum tax, and quarterly estimated tax payments. And I must admit that most trustees have a very difficult time with the quarterly estimated tax payments, and that should really be done by a professional, not by the trustee, in order to keep it from being messed up. Summary: in this module we talked about taxation of a trust which is irrevocable, the elements of DNI and its purpose, the source of trust income, and finally the distribution of the property. Did we cover everything there's possible to know on taxes? No, we try to cover at the top level, just enough that you as a financial planner can discuss intelligently with your clients.